Good morning, everyone. My name is Ryan Hughes and I am Investments Director at AJ Bell Investments. I'm delighted to be talking to you today about the AJ Bell Fund Solutions and MPS Solutions and give you an update on our thinking for 2024 and how we are positioned, and also talk you through some of the major events that are going on in the world and dominating markets, and also talking to you about the changes that we have made to the portfolios most recently to capture that. So let's crack straight on and give you just a quick update on the investments business. We've been going now about 7 years. The funds have got a nice long track record, and the team is hugely experienced that run all of our strategies, covering both MPS and funds there. What's really nice for me to see on the right hand side is the continued growth of our AUM, and we thank all of you for your support over the years and trusting us with your clients' money. We've now as a team gone through over 5 billion of assets there, and you can see the growth over the last few years, and we're obviously very pleased with that, and continue to see a lot of interest in our strategies, which hopefully will continue to grow from here. Performance has been strong, as we'll come on to look at. We were delighted to be recognised by Citywire recently for our investment performance, and we continue to offer our strategies across a wide range of platforms, including the AJ Bell platform, of course. If you are interested in seeing our solutions on other platforms, then do please get in touch, because we do want to continue to broaden out the proposition, and therefore your support and encouragement to talk to other platforms is most welcome. So let's look at markets and have a really good think about what happened during 2023. You can see the patchwork quilt here of different markets, different asset classes. I update this one every year, and every year I try and see if there's a pattern. And year after year, we can see there is no pattern at all. And this, to me, highlights the importance of being diversified in our approach and in our portfolios. I think it's very interesting to look at this patchwork and think about which asset classes have been the best asset classes over the course of a year, and whether any of those asset classes have actually been at the top consistently. And you can see that just about every single year we find a different asset class or region being the best performer, which comes back to our point that we always make, if you've heard me speak before, that nobody knows what will happen in markets in short terms. I sit here today not knowing what's going to happen today, tomorrow, next week, next month in markets at all, and I don't think anyone can predict those. And I think that's really borne out by the short 1 year periods, where it's almost impossible to say what will be the best asset class over such short periods of time. Over the longer term, maybe we can have a better sense of the direction of travel there, but this really does point to the importance of having a diversified portfolio over time. Let's drill down in that just a little bit more focus on separating out that chart into equities and bonds. A very strong year for equities, of course, in 2023, and that's continued as we've come into 24. We've seen through 23 that it was the US and Japan that were leading the way, and that has continued to be the case as we've moved through the early stages of 2024. These returns are in local currency, but actually if we convert them back into sterling, then actually the strength of sterling has been a headwind, and so investors have given up some of those returns when converted back, but they have still been very strong as we look to the US and Japan. Now, UK's been a little bit more muted, and Asia and emerging markets, albeit, of course, when we look at this for the course of the year, those returns on an annual basis don't look too bad at all. It's just they're dwarfed by what went on in the US and Japan and indeed Europe there. But they certainly have been squeezed down a little bit in Asia and emerging markets, and I'll talk about that a little bit more in a second. We move to the bottom half of the chart and looking at fixed interest markets, then we have seen a strong recovery in fixed interests. Almost all of the returns, as we saw at the end of the year 2023, came from mid-November onwards, when the market moved on from thinking about, okay, where do rates stop rising, to a story of when do they start falling. and that made fixed interest look far more appealing. And so really quite encouraging returns from fixed interest late in the year, and again some of that momentum has continued through into the early part of 2024, and particularly seen strong returns from high yield. Now that's particularly pleasing to see for us in the investment team running these strategies, because those of you that saw the adjustments to our portfolios back at the start of 2023 will have seen that we made a reasonable increase in our exposure to high yield bonds, because the narrative we described at the time was we could see equity-like returns coming from the high yield bond market, but without taking all of the risk of equities. Now, I think when we see a return there of about just over 12% for the year, I hope you'd agree that we did get equity-like returns from the high yield market without taking all of the risk of equities. Now, as I'll talk about in a little while, that positioning has changed. And our view has moved on a little bit, but it was very nice to generate those returns through 2023. And of course, the broader bond market also performed well. And while cash has been a very appealing asset for 2023, as the narrative around the bond market and inflation and interest rates has changed, then it's really been a case that fixed interest has started to become quite a bit more appealing than cash now, which hopefully is good news for more cautious investors who've clearly got more of these types of assets in their portfolios. Now, however, it wasn't easy last year. And I've just got this image on the screen, really kind of just to try and demonstrate what it felt like, as I say here, for us as investors, for you as advisors, and then the end client as well. And it really was a roller coaster ride. Say much of the bond returns came in the last 6 weeks of the year. Before that, it was actually pretty difficult. Some of those equity returns, again, were backloaded, and you've seen quite a spread of returns depending on which region you've been exposed to. So the roller coaster here, I think, is a good analogy for how returns, how the markets played out over the year. But of course, we still ended up in a pretty strong place, actually, come the whole calendar year. And again, that momentum has continued into the early part of 2024, which is really encouraging to see. Now, why has that picture played out? It's all to do with the direction of travel of interest rates, or the perceived direction of travel of interest rates. Now, this chart here is the dot plot. It's issued by the Federal Reserve, and each dot on here represents a voting member of the Fed in terms of where they think their US interest rates will be as they go through 24, 25, 26 and beyond. Now, if we start on the left-hand side, when they issued this dot plot, the reason you've got a flat line is simply because that's where interest rates are at the moment. And as we move through into 2024, you can see that the range of outcomes starts to spread. So as I said, each dot represents a voting member there. So you can see that there is a spread of expectations as to how far rates will fall during the course of this year. And then we go into 2025, and you can see that range widens out even further, and 26, and beyond that, well, we're getting into the realms of probably too difficult to predict. There's too many variables as we look that far out. So it's not necessarily a case of where rates land that's so important on this chart. It's more the fact that the direction of travel is clear, and as you can see on the arrow there, the direction of travel is downwards. So just about all voting members of the Fed, where are we, bar one, if we go at 2025, are seeing a reasonable reduction in US interest rates over the next 18 months. Now, if we had a similar output for the Bank of England, the ECB, then I suspect we would see a very, very similar picture, but they don't give us such clarity of thinking. We have to interpret their words on the statements they put out rather than these explicit dot plot expectations. But the market has seen this and said, okay, rates have peaked. We expect the next move to be down. We're not quite sure when that is, and so this is where the market's still, over the last few weeks really, as we in the early part of 24, just been a little bit unsure for the bond market. Do we get the first rate cut in March? Is it in June? Is it later? Is it 3 rate cuts? Is it 4 rate cuts? You know, all these types of things are playing out, and on any given day, depending on which one of those factors is winning out, you'll see where bonds are either increasing or decreasing in value. But as I say, the direction of travel is clear. I think we can sit here with confidence and say that rates have peaked, and in the back half of this year, 24, and probably through 2025, that we will start seeing interest rates falling back, which of course is good news for fixed interest markets. Just turning to the broader economy here. So this is updated IMF data from January this year, showing growth projections, GDP growth projections by region. And I think there's a couple of interesting things to pull out of this. So firstly, if we look on the left-hand side in the blue box, we can see that global GDP growth is pretty steady there. We're not really seeing any acceleration, but equally, I suppose it's encouraging to see that we're not seeing any slowdown as well. So the left-hand bar is 23, middle bar 24, right-hand bar 25. So, relatively stable, steady growth. But I think it gets a little bit more interesting when you look at the detail as you move across the page here. We can see that the expected growth in the US is slowing. Expected growth in the euro area is increasing, albeit it remains pretty low. Let's be honest, sub 2% growth is a low point, and it's predicted to be only 0.9 this year, 2024. And then it gets quite interesting when we look on the far right-hand side, when we look at emerging and developed Asia. And yes, it's a slowing trend, 5.4, 5.2, 4.8. But I think we could all sit here and safely say, what would Western leader, developed market leader, politicians, central banks give for growth of around 5% per annum? I think we know that they would give quite a lot for that. And so, yes, the global growth is relatively flat and that there's no real change in the number, but it's being dragged upwards by the very strong global growth that is expected to continue to be seen in Asia and emerging markets, both and developed Asia and indeed developing Asia. And that probably is a little different to the narrative that you might pick up from the media in terms of all the doom and gloom about China. And that's been really dominating the news, and forgetting that India has been doing incredibly well, and other economies in the region are also performing pretty strongly. So what happens next? I guess that's the most important point here. I've just gone through on this chart. I've just got some factors that are influencing markets and things that we think will continue to influence markets during the course of 2024. Talked at the top point here about interest rates. Market expectations have really turned on their head, as we said. This is all about when will rate cuts come, not where do they stop increasing. So that's such a change in narrative from the last 18 months. The final point on that top section there, markets are ahead of policymakers. This is so important when we see that. But the bond market has moved so strongly, it's not waited for the first interest rate cuts to come before it moves back into bonds. And I guess this isn't the mistake that we see so many investors make, is that they're kind of waiting for that confirmation bias. They will start thinking about fixed interest when the first rate cut comes. Well, markets have moved. Markets are thinking now 12, 18 months ahead, looking at, okay, how many rate cuts do we come? When do they end? When does the cycle start turning again? Of course, we haven't even had the first one yet. So it's important to look forwards, look ahead as far as we possibly can, because markets are doing exactly the same and asset prices are moving accordingly. You don't want to miss out on that first part of that move. And so thankfully, the portfolios captured a lot of that fixed interest rally in the back end of 2023. Talked about global growth on the last slide and said here it remains challenging. I guess the image of pushing a snail uphill feels apt. It's relatively flat in terms of that there is no acceleration. And as I mentioned on that last slide, that Asia and emerging markets are dragging the data upwards there. So it's not all doom and gloom in that region, despite it being very challenging from a stock market perspective in China over the last 18 months. It's been a completely different story with India. India has been firing on all cylinders, fantastic economic growth in 2023, and the stock market performing well, and a really positive developing story there. And the portfolios have had good exposure to the Indian market, which becomes a much has become a much larger part of the Asia and emerging markets indices. Now, China did dominate those indices. It was roughly around 40% of both the Asia and EM benchmark. Now, with China's challenges, it's fallen back to more like about 25%, and India has increased from around the 10 to 12% mark to actually around the 18 to 20% mark of those indices now. So what we're seeing is a much more broad-based structure of Asia emerging markets indexes, which I think is a really healthy development. It's an encouraging development, and it's not all about China. Whilst that might continue to dominate the headlines, continue to dominate the media, you do need to think broader than that when you're looking at whether it's our strategy or any other strategy that's got exposure to Asia and emerging markets, and look at the underlying exposure to the likes of China and India and Korea, etc. Still continues to be about the Magnificent Seven. I feel like I've been talking about the Magnificent Seven for much of the last year. They were the big winners of 2023. A lot of that has continued into the early part of 2024, but we are starting to see some of those share prices just struggle a little bit. The Apple share price down 20% from its peak. Tesla broadly similar as well. So maybe they're kind of going up in a straight line has certainly slowed. Couple of interesting points, I suppose, to make. So the S&P has never been as concentrated as it is now, around 30% in the Magnificent Seven stocks there. And that is, if we look at history, long-term history, generally the largest stocks in the S&P 500 have really added up to really no more than about 10% for a very long period of time. Say they're now at 30%. So it is really the S&P 7 and the S&P 493. And many investors are thinking about them in separate ways, and so we're starting to see more and more investor interest away from large cap stocks and into the lower part of the S&P 500. Of course, there are many huge companies outside of the Magnificent Seven, most of which would comfortably get into the FTSE 100 there. So we're not talking about small caps. These are still very, very large, well-known companies. The bottom point on here, I think, is an interesting one. There is a significant number of major elections. In fact, half the world's population is going to the polls at some point during 2024. Now, that number, of course, is skewed by India with its billion people population there. But we've got the US election later in the year. We've got the UK. We've got India, as I mentioned. We've had Taiwan electing a very anti-China leader, unsurprisingly, given the noises that President Xi is making towards Taiwan. We've got the Mexican election, which is topical given the US election and the issues around the border, which is definitely a topic which is being spoken about a lot by both parties in the US election. And we've got the European parliamentary elections there. So not necessarily one for each country, but I think we'll probably see quite a change in the makeup of the European Parliament as we go through those elections in the middle of the year there. So I don't really know how any of these are going to play out. Many a fool has been made predicting the outcome of political elections. If I was to put my hat on one of them, I would say Prime Minister Modi will be re-elected the leader in India. I think that's probably the only one I'd be happy making a prediction on. But the rest, let's stay well away from those. But they're important events, and they are likely to create volatility as we go through the course of the year, and so we will be alive and alert to that volatility and maybe any opportunities that it does look to offer us. I just wanted to do a quick reminder of our investment process, because it helps kind of set up why we've made certain changes to the portfolios. So there are three inputs into our process. We've got the expected return of our assets. These are long-term, forward-looking expected returns. What is the market pricing in for those expected returns? They're not our numbers, they're the market's numbers, which of course is the average of all of the market participants. We've got volatility, which is historic volatility, and correlation, again, historic correlation. And there we're using numbers from a long period of history, in ensuring that we incorporate the financial crisis there. So we've got extreme stress periods in our long-term data. We think that's important. Excuse me. Now we optimize those assets together to create the optimized, most appropriate balance of assets for each of the risk levels that we talk about on the slide here. Now, I talked about expected asset class returns. Just wanted to show these and give a little bit more color and flavor around these. So these are the core asset classes that we model as the core element of our portfolio. I've got the numbers that we use for 2023 and the numbers that we use for 2024 there in the two columns, because it's interesting to see the shift. So expectations of cash returns clearly increase because interest rates are much higher, and actually expectations of fixed interest returns also higher there, given the yields on offer. And that's true both in the UK's terms and indeed in international bond terms. Now, it's interesting when we get into equities, because actually what we're seeing in the long-term modelling is that there are lower expected returns for equities, albeit rather marginally lower, but lower nonetheless, and slightly lower returns on commercial property, which I always have to stress is listed commercial property. We do not invest in physical commercial property, given the liquidity problems. We never have done, we never will do, and we managed to avoid being caught out in all of the problems in those areas. So listed property is something to always remember when you see that exposure in our portfolios. So these are the expected returns that went into the optimization. Now let's talk about actually, okay, so what did that show us that how should we position the portfolios? So these are asset allocations as we go through 2024 now. They're kept under review, of course, but if you look at our portfolios, this is what you will see. A lot of numbers on the page. I'm not necessarily going to go through all of them, but I will just talk about a couple of tactical adjustments that we've made there. So we make tactical adjustments relatively infrequently. We do it when we think there is the opportunity to either enhance the return without changing the risk characteristics, or indeed to reduce the risk of the portfolio without impacting the return too much there. And a couple of adjustments we've made. Firstly, we've reduced the suggested cash exposure from the model and moved that into UK gilts and corporate bonds. Now, while cash returns are currently high, given interest rates are likely to fall back in the second half of the year, we expect those returns to fade, and therefore the returns on offer in gilts and UK corporate bonds are more appealing, where we should be able to get not just the coupon component, but also hopefully some capital gain from that exposure as well. So we would expect that to outperform cash over the coming year and beyond. Global government bonds is a core asset class for us, but actually at the moment we can get a yield pickup by investing solely in US Treasuries rather than the full global exposure, bringing in things like European bonds and Japanese bonds with their ultra low rates there. So there's a yield pickup that comes from owning US Treasuries. So we're owning, you'll see that in the portfolio as opposed to a more diversified global government bond holding. And of course, that means we also have a slightly higher exposure to US dollars, which is a nice hedge to have if we see volatility pick up in markets. Now, I mentioned high yield earlier on, and high yield was a really important asset class for us during 2023. It did very, very well in the portfolios, and we increased the allocation at the start of 23. As we go into 2024, I think the picture is a little bit different there. Clearly the interest rate environment is different. We've got companies now having to refinance in a totally different regime than they were before. And as you saw earlier, we've got slowing, in some instances, slowing economies, particularly in developed markets. Therefore, we don't really want to get too greedy with our high yield exposure. You're not being paid a huge amount of additional coupon, additional return over investment grade bonds for the risk you are taking. So as a result, we've reduced our high yield bonds, taken about half of the position out this year, and recycled that into UK corporate bonds, where we're still getting an attractive pickup and yield over cash, but we think on a risk-adjusted basis, it's a much better place to be than high yield bonds at the moment. So a small adjustment there, I say about half our high yield position being moved into UK corporate bonds. All of this has had an overall impact on our duration. We've increased our duration by about half a year. We increased it last year by about half a year, and we've increased it again by about half a year. So by no means are we long duration. We're maybe about neutral or just below neutral in our duration positioning today, but still kicking off a decent yield. On the equity side of things, just a couple of brief points to mention. So we have reduced our exposure in US equities there. Now, on the earlier slide, you saw the expected returns, and there's a couple of points maybe to comment on around this. Now, clearly the Magnificent Seven have done incredibly well and have dragged US markets higher. We think it prudent to lock in some of those gains, and so we have taken some of the profits on the US equity side and reduced them by about 4%. We're not talking large amounts here, but reduced US equity by about 4% and recycled that into Europe and Japanese equities. Now that improves the diversification of the portfolio. It broadens out some of the currency exposure. So obviously I talked in the fixed interest element about having more dollars there. Well, in the equity side, actually, when we're just kind of neutralizing some of that out a little bit from a European and Japanese perspective there. So small adjustments to the equity exposure for this year, and a very marginal reduction in listed commercial property. This is more to do with the volatility characteristic increasing than it is to do with the return characteristics. So that's summarized on this page, where we've got the top half, the SAA, the Strategic Asset Allocation adjustments that our modelling has suggested we implement, and the TAA underneath where we have adjusted those. I won't labour the point, as I've just gone through it on the previous slide. I do just want to mention the importance, the continued importance in our mind of having unfettered research. So yes, the AJ Bell funds are made up of passive instruments, and then we've got our passive MPS, our blended MPS called Pactive, and our active MPS. Now, in all instances where we're using passive investments, tracker investments, we want to make sure we're using the best provider for the asset class we want to implement in there. So at various different asset classes, these different providers you can see on the screen have different skill sets, have different capabilities there. So we think there are some fantastic passive solutions across the industry, and we're really lucky from operating on an unfettered basis that we can cherry pick and choose the right managers for the right asset classes there. So just picking out a couple of examples, State Street in high yield, Spider in US equities there, Amundi in Japanese equities, a whole raft of different options that are available, and that really helps us drive down our pricing and the cost, and also making sure we're using the most efficient passive providers that we can in the market. So just to run through the range as a reminder for those that aren't too familiar with our full range. So we're operating across the 6 different risk profiles, if we think about that on a DT basis, but we're mapped to many other providers. You can find that on our website. Passive, Pactive and active MPS, and indeed a responsible range as well, which is built on the same asset allocation process, as well as the growth fund range there, which may well be interesting for you, particularly given the changes around capital gains tax rules. Maybe the funds could be seen as more appropriate vehicles than the MPS, given how they operate. But also income, we're conscious that income strategies also are gaining popularity, again, particularly as more and more advisors think about the decumulation phase of investment, and so there are income funds and income strategies in an MPS basis, both on a passive and active side there. So a very, very wide range of solutions for you to meet the widest possible needs of your clients. So just turning to performance, I think it's really interesting. The ranges that we run are risk targeted range, and therefore it's not all about performance. It's also about ensuring that they deliver a risk experience that is one that is equal to that the client has signed up to in terms of their own risk profile. So this is just looking at risk versus return, the traditional scatter chart that you'll be familiar with seeing. And what I've put on here is each of the red dots represents one of the AJ Bell growth funds, and the blue dots represent the IA sector, so the mixed 0 to 35, 20 to 60, 40 to 85, and flexible there. Now, what you can see over the last 5 years is consistently that the AJ Bell fund range has delivered a return in excess of the sector average, so the multi-asset peer groups, if you want to think of it in that sense, but without taking more risk. Essentially, the picture is as you want to see it. It's generating a higher return over the last 5 years for similar or lower levels of risk, and that's particularly true when we look at the higher risk end the portfolios, where they are really delivering, as we would expect, that higher level of return. And we kind of focus on that balanced area. So if we think about the third red dot along, obviously the vast majority of our clients are in our balanced strategies. You can see that they're consistently delivering a much higher return for a level of risk that we would expect to see, and is lower than the peer group. So I'd say a picture you would hope to see, and we're very proud that that is the outcome of our solutions over the last 5 years. So just looking at performance in a different way, just thinking about this on a discrete calendar year, there's a couple of interesting things I think to comment on here. Firstly, the quartile rankings change, markets change, markets evolve, and so it's no surprise to see that they do move around: first quartile period, second quartile, third, etc. Worth just touching on 2023 because there are a few third quartiles on there. Now, actually, that doesn't really surprise us in terms of how these strategies are delivered. So each of the portfolios delivered a return of between about 5 and 9.5% for 2023. That is pretty much in line with our expectations in terms of what we published at the start of last year for our returns. So what we would have said if you'd have heard me present a year ago, I would have said if you think markets are going to perform particularly strongly, then I would expect others to perform better than us. But if you think things are likely to be more challenging and weaker, then that's generally where we come to the fore. But most importantly is when you stitch these together, you get the picture you just saw on the last chart, which is actually a much better risk-adjusted return and hopefully a smoother journey. So if I think about 2023, well, who did well in 2023 in the sectors? Well, if you want to look at that, I'd suggest that also what you look at is how they did in 2022, because what you'll find is that those managers that were the best managers in 2023 were actually the worst managers in 2022. I'm kind of generalizing there, but the picture is relatively consistent across the different sectors. So those that underperformed in 22 had a good recovery in 2023. We were very good in the down year of 22 and nice and steady with a decent single-digit return during 2023. Stitch those two together, those 2 years, and actually we still come out incredibly strongly in our performance versus those peer groups. So don't think about isolated periods. It's important to look at the whole picture, and we continue to be very, very pleased with how these strategies are performing. I talked about expected returns. The ones we published last year, we delivered on about exactly as we said. So this is the 2024 expectations for the asset classes that we have just run through, the asset allocation. What you read, the change picture you can see is really mostly focused at the lower risk end, where the returns are higher. They've increased because yields on fixed interest and cash are higher. So that's been the where the change has been. So last year you had a kind of more of a traditional steeper curve from the lower risk to the higher risk of your performance expectations. Now, as you can see on the numbers here, you've actually got a flattening out of that curve, where there's not a huge differential between the different risk strategies, whether you're at the lowest risk end or the highest risk end. Now, clearly these numbers do compound over time. They would make a very large difference, but on a 1 year basis, that we've seen a flattening of the expected returns out, but importantly still appealing and above cash and inflation. So just want to touch just very briefly before I summarize and come to an end, just on an additional strategy that we launched in November, which is our money market MPS. Now, some of you may have seen this or hopefully been made aware of this. So we were certainly getting demand and requests for additional solution at the lower risk end to help clients manage their cash exposure on the platform. And so we launched a money market MPS, which is a nice simple product made up of 4 money market and ultra short bond funds there. So the one ultra short bond fund is investing in bonds that have less than 1 year's duration. So it's a very, very low short duration strategy that behaves relatively similarly to cash. And then there are 3 money market funds, both investing in both government paper and indeed government and commercial paper as well. A couple of key points to mention about this. Firstly, we're not charging a management fee on this strategy. I think that's unique in the market as at this time of making this presentation there. So that is, I think, quite a differentiator. The underlying OCF of the strategy is about 0.1% there. So you can get some diversified exposure to cash-like products and cash-like instruments in our money market MPS. And as I say here on the yield, the current yield at the time of recording is just over 5%. It will change. So if you're interested in this product, then do speak to one of the AJ Bell team, and they will be able to give you the current yield on the strategy at any point in time. And now this is exclusively available on the AJ Bell platform. So again, if you're interested, then take a look at the platform. There's a lot more information online. So just to summarise that up over the last half an hour in terms of how our portfolios are positioned and how we see this year playing out. As I mentioned, the key inflection point around inflation and interest rates has been reached. This should be a big positive for long-term returns, particularly for those fixed interest investors and more cautious investors who've had a tough time. There's no getting away from that. We've seen bond prices, gilt prices fall back very, very sharply over the last 18 months, and it's really encouraging to see over the last couple of months a big bounce back in those. Still think there's value in equities. I would say there's small adjustments away from the US, given how strongly they have performed, locking in some of those profits there. But important to remain diversified. That continues to be our watchword. I've talked about some of the challenges and some of the risks and threats that are out there in the markets, and so we want to be diversified both by asset class, by region, by sector, by currency. That's really been the key characteristic that's seen us through the challenges over the last few years and navigate those years where, particularly those tough years when we've seen a lot of downside in markets, that has come to the fore. And this process has been well and truly tested over the last 6 or 7 years. This low-cost approach that we have with a proven process has really limited those downside risks when they've come along, and long may that continue. Thank you very much for listening. As ever, we are delighted to take any questions that you have once you've listened to this. So do please get in touch with your usual AJ Bell contacts, and we will be happy to come back to you with any questions, comments, or thoughts that you have. Thank you very much for listening, and we look forward to speaking to you again soon.